projected growth rates of the countries in 2020 read unfortunately like the golfers' handicaps. The IMF, in its latest projections, have indicated that the world output would decline to minus 4.4%. The Indian economy, which was among the fastest growing, is projected in 2020 to be among the steepest declining economies in the world. After the three European economies of Italy, which will decline by 10.6%, Spain minus 12.8%, and France minus 9.8%, where the pandemic hit earlier, India's economy is expected to fall by 10.3%. RBI has also predicted a more or less 9 odd percent contraction. Other larger economies like Brazil will decline by 5.8%, Russia will decline by 4.1%, and China, where the virus began, is among a few which would clock a positive growth and is expected to grow by 1.9%. These are, of course, projections, and the growth could either be worse or better. But at the moment, the only certainty seems to be that global economic outlook is uncertain. When the pandemic will be over is anyone's guess. What will be the impact of the health crisis and subsequent economic dislocation is also uncertain. The governments around the world are responding to the health and economic crisis in their own wisdom, which is not surprising, giving, given that there is no one size fits all response to this situation. The various reports indicate that the world GDP is not expected to return to December 2019 levels until the end of the 2021 second quarter. It is also generally being said that countries with large exposure to trade may take proportionately longer to recover in the scenario where the pandemic becomes drawn out compared to countries with lesser exposure to trade. Two common fallouts of the pandemic everyone agrees on is that one, poverty is set to increase. The pandemic is expected to reverse the progress made since the 1990s in reducing global poverty, and close to 90 million people could fall below the $1.90 a day income threshold of extreme deprivation. Two, income inequalities is expected to widen further. The pandemic will have particularly adverse effects on economically more vulnerable people, including younger workers and women. So I guess the policymakers will have to deal with more poverty, higher inequality, and several setbacks to human capital accumulation as they chart out their next course of action. Also, policymakers will have to find solutions for falling government revenues and rising expenditures. India went into a lockdown on March 25th. Restricting 1.3 billion people was a mammoth task, and the entire economic activity came to a grinding halt. With the unlock process underway of late, few indicators like power consumption, passenger vehicle sales, and e-way bills are showing signs of revival in India. But a sharp recovery is unlikely to occur during this fiscal. In the current scenario, it is even harder to predict when economic activity could return to pre-virus levels, largely because of the health crisis and the government's fiscal response. The government of India's response has been a combination of fiscal stimulus, as we all know, to spur domestic demand and to sustain investment. The emphasis has been on revival of micro, small, and medium enterprises, the self-employed, and the casual workers who have been the worst casualty of the COVID-19 induced lockdown and subsequent disruptions. Agriculture is also getting large allocations. There is also an emphasis on Atmanirbhar Bharat. There is a concerted effort to work on a China plus one policy. The government has identified 12 champion sectors, and the emphasis is on value addition within the country. The India-China relations have added another dimension to the crisis. As a consequence, there are also several voices around aggressive import substitution, hiking import duties to encourage Make in India, and some extreme views to ban certain imports. These are equal number of voices suggesting that having traveled the path of liberalization, any attempt of creating artificial barriers and protectionist measures would be like throwing the baby along with the bathwater. But I would like to conclude on an optimistic note that if economy is lying flat, it has to only look up in any case, isn't it? We heard Dr. Rajiv Kumar, Vice Chairman, Niti Aayog, in the previous session, referring to the fact that we are already on a path of recovery. We have a fantastic panel of experts who need no introduction, and they will throw more light on where the global and Indian economy is headed in 2021. The session will be moderated by my able friend, Anil. I welcome you all again and hand the session over to Anil. Over to you, Anil.
Thank you, Ravi. That was an excellent introduction. You have summed up the entire issues ahead of us. And before that, thank you, Pafi, and congratulations on your 12th year. It's a remarkable growth from the year one to now. You seem to be growing bigger and bigger. Wish you all the best. So, like Ravi said, we have a great panel, actually Manel here, so who will delve into the bigger issue of what to expect in growth in 2021. The way we do it is we got 4 panelists, each will go 3 to 4 minutes with opening remarks. Then I'll come back with a few questions, and those who are watching, please do share your questions. Our support team will share the questions with me and I'll feature them here. So just to add a little bit to what Ravi has already said, an extensive summary. I think we were heading in a perfect storm. Even before the pandemic hit us, the entire globalization phase was running out of steam. Global growth had begun to fragment, all kinds of stress lines had come. And the pandemic came and it's just hit the reset on almost everything. So we are in a very difficult year. It's probably a gap year, 2020 in global growth. Like you forecast, there'll be a contraction of 4% or little more. So that kind of sets the agenda for what we have this year. But there is hope, pure base effect next year, we will see a rebound. But that has to be gone into in detail. As Ravi has delineated very clearly, there are a lot of structural challenges that will have to be addressed in the next 1 to 2 years and probably longer. So without much ado, I will hand over to our panelists without any particular priority list. I'll begin with Omkar, who's also been my former teacher, so I'm allowed that bias. So over to you, Omkar.
That was your good academic priority list. I'm going to just take a few minutes. The first thing, and I want everyone to understand this very clearly. There are 2 ways in which you can measure growth. One is to measure what happened to a number, say GDP, in a quarter compared to the same quarter last year. So this is a quarter-on-quarter thing where you're looking at the same quarter of the previous year. And the other way of doing growth is to look at what happened to GDP growth this quarter compared to the previous quarter, which is, so if I'm looking at quarter 2, I will compare to quarter 1. Whereas in the first way, if I'm looking at quarter 2, I will look at quarter 2 of the previous year. In India, we take the quarter of the previous year as the comparison, right? So I'm taking this as, it's quite important. And the reason why I'm saying this, Anil, is that I think it's sort of clear that the second quarter of the fiscal year 2021 in India is almost definitionally looking better than the first quarter. So if we looked sequentially between quarter 2, which has not yet come, which came to an end on 30th September, and quarter 1, which came to an end in 30th June, we would have done better. And there are indicators that we are doing better. But that's not the way we measure GDP. We measure how we do in a quarter compared to the quarter going back. So if I were to look at that, I'm going to cut the long story short. We know that we lost by 23.9% in the first quarter. I think we will end up losing by 15% in the next quarter compared to the same quarter previous year. You will probably lose by about 7.5 to 7% in the third quarter and about 4 to 5% in the fourth quarter. If you were to weight it all down together, then if I were to look for the year in India, you would see something like a 12.3 to 12.9% shrinkage in real GDP growth. Now, it could be that every quarter sequentially is doing well, but no quarter is going to be as good as the same quarter in the previous year, and therefore the shrinkage. That's so. The positive point is, as of now, it's looking like things are looking better. But let us accept the fact that we are looking in somewhere in the region of 11 to maybe 13% shrinkage in real GDP growth when I look back 1 year behind. The second point I want to say is this is not so bizarre. I mean, IMF has come up with 10.3 and shrinkage. RBI has come up with 9.5% shrinkage. So, somewhere in the region of 12% is not so bizarre. I mean, guys are talking of 18%, 19%, 15%. Okay. The real issue is how quickly can we get back to normal? And I'm going to stay with India because I'm not the chief economist of IMF pretending to know everything, right? So I will simply say that as far as I'm concerned, we are probably going to take a 12% hit. We are going to have two major problems. One is the fisc. The exchequer simply will not be able to deal with the kind of monies going forward that we need, A, for infrastructure, B, for public health, which has to go through the states, because public health is a state subject, and the exchequer is going to be very badly hit. And my guess is, and this is no fault of the finance minister, my guess is we're going to see a fiscal deficit balloon to about 8 to 8.5% of GDP. It's not a fault. It's what's happened. And we will go through some limping. The plus point, and I'll end with a positive thing, there are only two countries, or maybe 2.5 countries, that are full of hustlers. One is China. Communism and all is all nonsense. They're all hustlers, okay? And one is India, where there are lots of hustlers. And in a smaller way, Israel is full of hustlers, okay? So the thing about India is the huge optimism of a large number of businessmen who want to get things going, even under very difficult times of working capital, banks not being right there, things are not happening, but they're hustling. The way I see my vegetable vendor, and he's one of my best friends, and I speak to him every day in the morning, and I know where he lives, what he does, including also my istriwala, because these are the people who matter, right? They are all, life was difficult, but they know how to get over it because they have to get over it. And that's the positive about it. I'll stop here.
Okay, thanks, Omkar. Your references to the pakoda economy are interesting. So not to be ignored, not being facetious. Taimur, if you can go next.
Sure. Thank you very much, Anil. I will pick up on where Mr. Goswami left and add some specific numbers. So yes, it is true that on a year-on-year basis, we're looking at double-digit contraction even in the second quarter of the fiscal year, and perhaps high single-digit contraction. We estimate about 8% in the fourth quarter of the fiscal year. But to put it in perspective, on a quarter-on-quarter seasonally adjusted basis, the July, August, September quarter for India may not look that different from the July, August, September quarter in the US, meaning that after the huge contraction of the April, May, June expansion of the economy be something like 30%. That, of course, is neither here nor there. On a year-on-year basis, it is still a very sharp contraction. And by the time the real GDP level goes back to pre-COVID level, would be toward the end of 2021 if we are lucky. So it's not just 2020 being a gap year. By the time we have made up for the losses, it'll almost be end of 2021. So we're looking at a minimum of 6 quarters of being lost, and that's a huge loss. There is a strong word that is used in the economic circle these days, which is called scarring. We're worried about people remaining unemployed for a long time. That diminishes their human capital. So therefore, there's scarring risk as far as the labor market is concerned. There's also scarring for the overall economy's potential. Leaving things idle leads to depreciation and degradation. And the faster we can get those things humming again is better. Otherwise, again, there is an overall economic scarring. So that to me is the biggest risk. It's not the likely bounce back of the economy after an unprecedented contraction in April, May, June. It's about how long it takes for us to retrace the losses of these quarters. If it is running into more than 5-6 quarters, that risk of scarring gets to be very, very severe and harms long-term potential GDP growth substantially. Now, I sit in Singapore and I have to explain India to foreign investors on a regular basis. And one thing that investors always ask me is, and again, I go back to Mr. Goswami's final point, that the Jugaad aspect of Indian entrepreneurs is amazing. I remember Tarun Khanna at Harvard wrote this amazing book called Billions of Entrepreneurs about 10 years ago or so. And again, his point was that when you are dealt with a lot of constraints, it actually fosters creativity, problem solving, and which is why you have such outstanding global business leaders coming from India. That is true, but global investors don't really care about the entrepreneur's zeal. They care about the return on their investment. INDY is the iShares dollar-denominated index of Indian equity market. In 2010, that was trading at about 31. Today, it's trading at about 36. So we have gotten about 1 to 1.5% annualized return in US dollar term from the Indian stock market over the last decade through all the cycles and around elections and economy and structural changes. Now, that is very disappointing. If you had put the same amount of money in US stock market during those 10 years, you would have more than doubled your money, close to actually tripling your money. So we always think of emerging markets as riskier, but also higher return, higher excitement destination. Now, when will India become that exciting, high return, high risk destination, as opposed to delivering a very middling 1.5% in US dollar return over a decade, so 15%, 20%, no more than that over 10 years. So that's the issue as far as foreign investors are concerned. Now, my final point is that having had a very disappointing track record of returns, India still captures the attention of global investors like very few other economies do. If you look at FDI numbers in Asia, of course, China is number one, Korea, Singapore are numbers 2s and 3s, but after that, India is the rising star, has attracted substantial FDI, I think about $200 billion in the last 5 years, and will continue to do so. So the attraction of the global investor base is still there in India, but we cannot go with another decade of 1% annualized return. We have to do better than that.
Thank you, Taimur. I think you've set out the contours that India needs to track to get into the good books of global investors. If I can request Mukesh to go next. Javed, I'll come to you last as a fellow journalist, so if you don't mind.
Well, good morning. This is Mukesh Aghi, and I will give you more of a U.S. perspective. When you look at the U.S. economy and the quarters here from January to December as compared to what you talk in India because of your April to March year end, the second quarter in the U.S., we saw almost 32% of the GDP contraction. We saw consumer spending down by 34%. We saw business investment fall by almost 29%. And export from the US dropped by 63%. And unemployment shot up from below 4% to 14%. That means almost 22 million Americans were unemployed. This is the fastest contraction US economy has faced. It's faster than the Great Depression, which took place 70 years ago. The Fed and the Treasury and the economists put a 4-point strategic plan. One is to make sure that the economy does not go into further spiral and make sure that the economy starts picking up steam. One was to make sure that the employees' payrolls are protected. So they launched PPP, which was funded, and I'll come to that. Made sure that the expanded unemployment benefit for the employees go long-term rather than 8 weeks itself. So that brought some sense of liquidity to the families itself. Then focus on bringing the interest rate down to almost 0%. And more important is launching and announcing by the Feds that for the next 3 years, there will be no change in the interest rates. It'll remain down to that low level itself. And finally, the Fed and the Treasury ensured that there's a cheap credit flow both to the household and to the organized companies itself. So those 4-point strategy was what was executed. And in that process, the Congress approved a $2 trillion CARES Act, and where almost $603 billion went to individuals, $500 billion went to large corporations, and $377 billion went to small businesses, and to state and local government, almost $340 billion went down, and public service, $180 billion. So when you look at the spread of $2 trillion, it was both to get the demand going and also revive the supply from both sides itself. And what we saw, the effort of the impact of that was that in third quarter, GDP grew almost by 30%. And it's very interesting to see the consumption went up, especially in luxury items, in luxury cars. They just shot up dramatically itself. And more important is the housing market picked up. People were buying more houses in suburb itself, and especially in the high-end housing, the inflation went up itself. And more important is the consumer disposable income by third quarter went up by almost 9.6%. And what's interesting is the typical average saving of American is 9%, whereas in third quarter it was almost 26%. So what we see is that by 2020, by end of this year, the economy is forecasted to contract by 4.9%. And if the second stimulus package gets approved by the Congress, either before the election or after the election, we expect the economy in 2021, the forecast is averaging around 3.8% positive growth. And we expect the unemployment to come to the 2019 number of below 4% more by 2023. Again, all these things will happen depending on the course of the economy, will depend on the course of the virus itself. As you know, the virus is peaking both in Europe and United States, and it may change the trajectory of the economy depending on how we handle that virus. Thank you.
Thank you, Mukesh. Thank you for reminding us that a lot of things depend on how the course of the virus. Now, last but not the least, like I said, my fellow colleague, Javed, over to you. You're muted, Javed.
Can you hear me now? Yeah, thanks. So after the sharp contraction of 2020, there's obviously going to be a rebound in 2021. So there's no rocket science there. The question, of course, is that the rebound will depend on the extent of fiscal support, on when and how the vaccine rolls out, on whether there is a second wave or third wave. So there will be a rebound, but the extent of rebound we'll have to see. For India, I think I agree with Omkar's numbers, and I think and I also agree with what Taimur said, the scarring point, and I think that's an important point. And I think that both 2020, 2021, both are gap years. There has been some smart recovery over the last few weeks, and we've seen that in the online sales and in the Diwali sale. But whether this is pent up demand, whether this is more sustainable, we'll see in a while. But for now, I think that India has so far been a bit conservative when it's come to fiscal action. And I think that maybe a bigger stimulus is now required. And of course, the question is, where are the revenues? Where is the money? So it's not an easy question. But I think that we will need a big fiscal boost soon. Thanks.
Can I just come in, Anil, with one point on what Javed said, if I may?
Of course. Yeah, please.
Okay, so let's understand one thing. COVID by itself and otherwise, structurally as well, there are a couple of things. See, we have to understand that in India, more than anything else, the GST has been completely shot up. Revenue from the goods and services tax, not only because of COVID, but otherwise, 1 year before COVID, it started declining. It's been the largest source of revenue has been completely shot up. Okay. And therefore, going forward, if you were to superimpose COVID on it, you just don't have the money. So right now, one way or the other, however parsimonious she has been or however non-parsimonious she has been, 1.3% of GDP has gone between fiscal stimulus 1 program and fiscal stimulus 2. I'm not talking of all the other programs. I'm saying it comes out of the exchequer. You know, it's not just looking at what the rating agencies are going to say. Yeah, we actually don't have the money. In the United States, it's a greenback economy. It's the greenback. It can do what it wants. In our case, we just don't. First is we don't have the money, and therefore we've got to be a little careful in how we do this. And I don't have a problem so much, unlike many of my colleagues in the academic world, about you need much more stimulus. You've got to be a little careful about it. And the second is it's a Hobson's choice, Javed. How do I deliver that stimulus? I can announce stimulus. Tell me between Ministry of Finance and the Tehsildar, how do I deliver a stimulus? I'll stop.
No, you're right, Omkar. And also to add to what Omkar is saying, we are on the back of an economy which has been slowing down for several quarters now, right?
Eight quarters slowed down.
And it's been and every quarter and every year we revise the previous year's estimate, so the slowdown doesn't look that sharp, but it is pretty severe.
Javed, it's not unique to India. China has just done that to show a 4.9% growth, but it's escaped all analysts. I guess maybe Taimur can weigh in on this. But I'm actually we'll come back to the starting of the economy. I think it's a very huge point we need to get to. But before that, I just want, because we got two experts who are panelists who are based abroad and they are looking outside in. And Uday Kotak mentioned this in passing in the previous session, where he said that the pandemic is accelerating a geopolitics reset. So, Mukesh, you are right there with the United States, which is, I think, probably is electing a leader, new incumbent or a challenger, I don't know. But unlikely that the diplomatic trajectory of the United States is going to change on its head, no matter who comes to power. So this geo reset that we are looking at, I would like both of you first, Mukesh, if you can go on what it means for the world and of course for India too.
Well, the fissure between US and China will get deeper and broader. And you will see in every aspect, US will be challenging China. But at the same time, US also realizes that on its own, US cannot take China itself, especially in Pacific region itself. And that's where India comes in. So enemy of my enemy is my friend. And I think there are a couple of factors which play in favor of US and India. The China factors definitely comes in. US companies are also saying that our supply chain dependence on China is too high, and we need to be able to deleverage that. And I talk to most of the US companies on a daily basis, and they're looking for China one plus strategy itself. I think India has done a poor job trying to attract those companies. I think they're going to Vietnam, they're going to Cambodia, and there's certain factors which we can get into details later. But more important is, I think India stepping up and trying to work on the Quad, US, India, Japan, and Australia is a defense, and you have a 2+2 happening on 27th in India, both Secretary of Defense and Pompeo are coming to Delhi to talk about the defense strategy. But I think more important is how do you leverage a Quad, which is defense alliances, into economic partnership? I believe if your strategic interests are aligned, then you can translate into economic interests, which are also strategic. So I see an opportunity, and that's why we're pushing both government of India and the US and the Japanese to explore that. You can start from technology perspective, then get into economic and trade arena. But from our perspective, we see the relationship between India and the US geopolitically getting closer and closer as time goes by.
I'll begin by citing a few numbers, because just like Mukesh Aghi said, that you hear a lot about US companies trying to come up with a China plus one strategy, or that in ASEAN countries, there is this expectation that some of the supply chain will become fragmented and other countries, hopefully including India, but mostly in East Asia, will benefit. When I look at the numbers, I see a very different story. In 2015, US stock of FDI in Asia was about $850 billion. Today is heading toward $1 trillion. So about 12, 13% increase during the last 5 years. So if the narrative that the US businesses, because of 4 years of trade war, are shying away from China is correct, we probably would see US stock of investment in China to flatten out or go down, right? Absolutely not the case. During that time, US investment FDI stock in China has gone from 92 billion to 116 billion, almost like a 25% increase. So it really depends on where we focus on the newspaper headline. It's on the tech side, there's a lot of stuff going on. But if you want to import or sell furniture in the US, construction material in the US, toys in the US, Christmas ornament, it is always coming from China. That doesn't change. Now, as far as medical supply is concerned, as far as high-end electronics is concerned, a lot of the stuff was not built in China anyway. They were being made in Korea, Japan, Taiwan. Sometimes they come through China and go as input into a Huawei device. Americans were not buying Huawei devices anyway. So unless Apple starts moving its supply chain out of China, or major companies like Cisco, we're not going to see the numbers change much, even if, the rhetoric of the White House is extremely fiery and you think that the decoupling between China and US is happening. I think the FDI number and also the recent portfolio flows from US investors into Chinese fixed income market and equity market, and the desperation of American banks to be part of China-listed IPOs tells you that the actual numbers are bringing China and US closer together. Even when we hear the headlines, it seems like on military side, on high-tech side, the countries are going in opposite direction. So that's issue number one. Second issue is the role of the supply chain. So when you look at China and ASEAN, the trade in the region and to the rest of the world has gone up by something like 900% over the last 20 years. So it's not that the China's accession to WTO benefited China and impoverished ASEAN or Asia. Asia benefited tremendously from China's accession to WTO as well. So during the whole time, China's trade with ASEAN is about 50%. That hasn't changed, meaning ASEAN's export is also growing exactly the same pace as China's exports to the rest of the world. So the region is very well integrated. The country that is completely left out is India. ASEAN trades 3% of its total trade with India. What an incredible loss. Why don't we see Indian textile pharma goods coming to the shelves of stores in Singapore and Indonesia and Malaysia? Why don't we see Indian IT exporters of services, instead of obsessing over H-1B visa and accessing the US, look at all the opportunities there in ASEAN and trade with this part of the world? So I fully appreciate that geopolitics, and perhaps there is a natural alliance between US and India in pushing China back in military arena and maybe some degree of Swadeshi in India, import substitution out of China probably makes sense. I'm not going to contest that. But I think that there is a huge open field, massive opportunities in becoming open to trade with my part of the world around Singapore that India is missing out. It's a low-hanging fruit and it's not being plucked.
Very well
Omkar,
said. Very well said, Taimur. Kudos to you. That's the kind of honesty that one needs.
Absolutely. Agree with him.
Go ahead. Do either of you want to weigh in on this, Javed or Omkar?
No, I think we. It's actually quite amazing that how, except episodically, so like in 91 to 93, or occasions like that, except episodically, we don't have a comprehensive, continuous, well worked out policy of how to increase our trade footprints in the geographies that matter. We do things sometimes episodically, we do some things diplomatically, episodically. My basic issue with us is we are always talking with a great pride, but actually delivering very little on the ground. It bothers me, from 91 to now, when I was a young whippersnapper and now I'm 60, going to be 65, it does bother me that, we talk too much and do too little.
Javed, in the last, just to stay with what Omkar said, that where we are more of talk and less of action. But the last 6 months, maybe Omkar needs to revisit his claim. There have been at least like the farm bill controversy that's happened. So it's obviously something that is changing things on the ground, that the pushback is so hard. So can you weigh in on what he was just alluding to?
What you're saying is correct. So, I mean, in the sense that for the last 20, 25 years, we've been talking about second generation reforms, and two vital parts of that were were agri reforms and labor reforms. So the government has acted on both in the last 6 months. So therefore, to that extent, credit has to be given to them. The PLI scheme is also aimed at sort of attracting foreign investments, manufacturing, all those things. But Omkar's broader point that that over a longer time frame, we speak more and we deliver less is also undisputable, right? So both those things are there, and I mean, for me, the sad part has always been that, see, I started working 25 years ago, and at that point of time, we used to say an annual growth of 7% every year for the next 25 years will make us a middle income nation, and that hasn't happened, right? So that is the problem, and there are a variety of reasons for or against that. So sure, we do. The government has taken a lot of action, but much more needs to be done, and yeah, we haven't really delivered on our promise. That is the fact.
I'm just curious, Taimur, and all four of you actually, because this segues into the global trade problem. What was already a bad case has now become worse, and the collapse of globalization, all these issues, the frictions between the two largest economies in the world, and now stress lines around them. So this thing is, if you remember 2000, the first decade of the millennium, the big burst that China enjoyed and which even India enjoyed was to hang on to the coattails of a big global boom. And that revolved around the whole trade surge. That's missing from today's equation completely. So the odds against the world and the odds against India. If I can begin, Mukesh, if you could weigh in, because you're, again, like I said, looking inside from outside. And what do you think it means for the world and for India?
Well, understandably, while the global trade seems to have taken a hit, but you have to understand India has one advantage. It still has its own large domestic market. And US companies are looking at that market very, very eagerly, because as China becomes difficult to work with, and what we're seeing is increased investment from US coming into India. If you look at the first half of the year, the FTA has gone up in double digit from the US companies into India. So we are seeing a renewed interest, and I think that's where we need to see policy predictability, transparency, and level playing field for the multinational companies to come to India and compete. And so I think the domestic market can play a very pivotal role in growing the economy while the export market is still struggling.
Taimur, if you can also just, while weighing in, address the point Mukesh made that India needs to transition to a rules-based regime, which I'm sure you also see from outside looking in.
I think that when Governor Rajan was dealing with sort of slowdown in India and the BOP crisis, and then the issue around Made in India was coming in, and he sort of provocatively said that we should focus on Make for India before even thinking about Made in India for export orientation. I sort of agree and disagree with that argument, which is, of course, there's a huge domestic market, and if you can tap into that market for resilient demand, you must do it. And to the extent that you are sort of replacing some of the imports, that's great. But at the same time, without trade orientation, aiming for growth rates anything more than 5% is going to be very, very challenging. So if we are going to be satisfied with resilient domestic demand driven 4-5% growth, we can do it with inward orientation. But I think we all want much higher growth rate than that. And for that, one would have to embrace globalization and partnership with like-minded countries in both imports and exports. And I think the point that I'm trying to make is that you have to keep your markets open on both directions to benefit from it wholeheartedly. And that is absolutely important. Now,
100% right. 100% right, Taimur.
And if I may add just one more point, that global trade stagnation began about a decade ago. So we basically faltered right around the time of the global financial crisis, and we have not recovered since then. So if you look at global merchandise export volume, that fell by about 20% in 2008. After that, we have been growing at 1-2% a year, and of course, we'll lose ground again this year. The only good thing is that in the short run, say in the next 4 to 8 quarters, we do have favorable trade tailwind, both in terms of pharmaceutical and electronics, and therefore countries that are export oriented will be growing on the back of that. And the biggest example of that right now is China. If you look at the recovery path of the US and China over the last 5 to 6 months, it is starkly different. US growing on the back of very, very strong consumption. You heard Mukesh Aghi talk about how real estate sector, construction sector, retail sales are doing well. Absolutely correct. But production faltering, exports faltering. US actually just chalked up 2 consecutive months of $80 billion plus trade deficits. $160 billion of trade deficits in 2 months. I think it's an all-time record. Whereas China, opposite. Retail sales fairly lackluster, like India. Fiscal stimulus was not very, very large, but they managed to get lives restored. And now livelihood is following. There is no trade-off. First, you get the lives in order, then you get livelihood back. And what is happening in China? Production going through the roof, exports going through the roof. So therein also lies the critical lesson out of this crisis. You can aim for resiliency when you are a mature economy. You don't want too much downside, but you also have to give us some of the upside because you're just a mature economy. A country like India probably will be characterized by zigzags. You go very strongly, and then there's a cycle, there's some adjustment, creative destruction, so be it. We can't be that obsessed with resiliency. We have to focus more on the creative energy and the creative destruction capacities of the economy.
Thank you, Taimur. I'll just open up to the questions. We'll keep coming back in case we don't get enough questions, but we do have one. And somebody's asked, how do we engage and empower the public and the common man in the anticipated rebound next year? Omkar, if you can take this, and Javed, you too.
See, at the end of the day, there is a very, very large, and I'm sure Mukesh, Taimur, Javed, you, everyone, there is a very large, forget about the medium and small enterprises. There's a very large number of people who are not laborers, who are little entrepreneurs, who I call the vegetable seller, the guy who does the ironing on the road, the person who washes 7 cars in the morning. these are not salaried people, nor are they entrepreneurs who can go to the bank. They are the guys who across, or a guy who has a small shop, someone who fixes something or the other. Just go along anywhere, you'll see a whole bunch of small shops and people, selling pakoras or whatever they're doing. I mean, there are many more people doing that than anything else. If you can get that cycle back of those guys being able to earn an income where they can go back on a normal day and take care of their families and save a little bit, you're fine. You'll do fine. And I really do believe that we will need to go through maybe 2 more quarters. I mean, depending, as someone said, as I think Mukesh said, depending on how the virus goes and which way it goes. But if we can somehow manage over the next 2 quarters and get people back, because these guys want to get back to work. They want to earn a livelihood. They want to take care of their families. And we have to work on that.
Javed, just before you go, I think, Omkar, you're basically saying the informal economy has to kick back in, like,
Has to kick.
empower
And
the common people.
if the informal economy doesn't kick, you see, the informal economy is huge in terms of in terms of income earners, people who earn income and take care of families. If that economy doesn't kick in the next 2 quarters, we're in trouble.
Yeah, but I mean, fair point. I think without it, we'll have other social challenges.
Sure.
But the point Taimur is making is that if you want to really get back into the growth rate of 7 to 8%,
He's
as Javed
100% right.
said,
He's
you
100%
can't
right.
do it on the back of an informal economy.
The informal economy is 5%. To get 5% going on a decade basis, 5 to 5.5%, we need the informal economy to kick. To get to 7%, we have to finally start doing work, which we, policy reforms and executing them, which we haven't done for yonks.
Hey, Javed, can you weigh in on this, whether we go like the immediate strategies, like Taimur said, protect lives, then livelihood, which has to begin in the informal economy in India. And then how do we go from there? And
See, I think it has to be a combination of both, right? We don't have the luxury of sequencing. We have to do it both. And of course, I mean, I think what Omkar is saying is absolutely correct, that the informal sector, the informal economy takes you up to 5%. It's the see, what I've never understood is that I can imagine a steel worker in Michigan feeling let down or left behind by globalization. India is a beneficiary of globalization, right? For the last 25, 30 years, trade liberalization, all these things have helped us. So why? So when we start having, when we start questioning those principles, then I think we retard our growth. And I think we get too influenced by the debate in the West and then start thinking. Whereas for us, it's a net positive. So I think we need to move forward there. What Omkar is talking about, the informal economy, is obviously lives, livelihood. Both have to go in hand in hand. I don't think there can be two different tracks here.
this, go back to what Taimur mentioned about the scarring of the economy. Taimur, if you can weigh in first, I won't come to Mukesh. At the global level, I'll look at the domestic level to Omkar and Javed. But the scarring of the global economy, which are the big, top three things we need to watch for as we go forward? You did mention low growth, but beyond that.
So, there are lessons to be taken away from the 2008 crisis, that when we look at graduates who were entering the labor force in 2008, 2009, that it has taken them a full decade, and some of them still have not caught up to the lost income that they had to endure in those 2 years, which is why it is very important that you don't let people both lose jobs in very large numbers or have absolutely no opportunity to enter the labor force. So you're seeing this in Europe, you're seeing this in my backyard in Singapore, that the governments are coming up with traineeship programs where they are not paying people massive amount of unemployment benefit, but they are giving companies incentives not to fire people, or on top of that, hire trainees, apprentices who will at least have the dignity and self-respect of going to work, making much less money than they would have, but it's much better than not making any money, not going to work. So just the act of going to a company, making a little bit of money, learning things by osmosis itself is a very valuable thing that can prevent some of the scarring on the labor market side. Next is the issue of industrial sector scarring. There, you have to actually worry about some of the neoclassical solutions instead of just letting things go on, which is, do you want a zombified economy? We saw this in the case of Japan after the bubble burst in the late 80s. You had 10, 20 years of very expansionary fiscal policy, extremely accommodating monetary policy, which left companies that should have gone out of business stay in business for decades, very, very inefficient. I don't think we can afford that, not in emerging markets, not in developed markets. So some of the support that are being extended to companies at some point have to be taken away, and they would have to then, their shareholders, their owners have to decide whether the company can go on or declare bankruptcy and come back perhaps in a different shape or form. And if you think about it, in hospitality and transportation, many things probably would require a severe degree of creative destruction. So you can have scarring both ways. One is not let people have any opportunities, at the same time give too many opportunities to companies. So you got to calibrate those two.
Thank you. Mukesh?
I think what I worry about is a couple of things. One is the U.S. debt. If you look at U.S. debt, is crossed $27 trillion, which is now almost 136% of the GDP ratio itself. It was debt to GDP ratio. And when you look at the recommendation by IMF, as anything above 77 becomes a tipping point. So that's one big issue. Second is in the eagerness to revive the economy and push cheap credit availability, loans available to business, the default ratio is going to go up at some stage. And so you want to make sure that banks' stress tests are still valid. And I think what we are seeing is Feds are making a lot of effort to ensure that the banks stay quite below the radar from a default perspective also. But more important is, I think, the U.S. defense spending. It is over $1 trillion a year, and I think that has to be curtailed. U.S. has roughly around over 800 bases outside U.S., and those are not sustainable from a economy perspective. So I think whoever comes in after the election, those are three things which we have to be looked at very carefully to ensure that you bring some more fiscal responsibility to the government, rather than keep on printing the money and reviving the economy itself.
Thank you. Before I come, Omkar, there are two questions which have come, which are actually contradicting each other on the MSME. One says that are we too mollycoddling on MSMEs? The other one is saying, what else can you do to revive the MSME sector?
Yeah,
So,
my answer is very simple, Anil. Try running a business where in the best of times, you had to run after the bank in order to get the expansion in working capital that you needed, or a cash credit facility that you needed in order to execute a business. You got an order, your working capital was not enough, you wanted cash credit facility, you had to go to the bank, right? And if the banker didn't want to spend time with you, or the deputy manager or whoever else was in the branch didn't want to spend time with you, you had to figure out how to get this money in order to do the business. Okay, MSMEs basically run on very fast turnaround. A successful MSME, fast turnaround of capital, right? When that breaks, it significantly breaks the basis of the business. It doesn't break the entrepreneurship. It doesn't break what they do, but it breaks the basis of the business. So unless you get that back again, either through active bank support or by support of people who are buying their products, it gets very badly broken. So it is quite critical in India. And to some extent, the finance minister has understood it. But at the end of the day, there are many slips between the cup and the lip. They actually don't get the money.
So you obviously are saying that we haven't done enough for MSMEs. To the other part of the question.
I'm saying that we have done enough in terms of saying this is what the policy is. And I do know that they're trying to figure out what is it that the banks are actually doing. But at the end of the day, there are so many plethora of approvals that are needed that the poor guy who needs an extra, 1.5 lakhs or maybe 3 lakhs or 4 lakhs to get the business going is not getting it. Maybe he is, but it's taking far too long, and that 3 lakhs then becomes 5 lakhs.
So Javed, I'll pose that tough question to you, which has come from the audience, that they say that whether politics is defining the economics, we are going, the word used is mollycoddling the MSMEs. Is that correct? You agree or?
No, see, so I think the chief economic advisor had made a good point in I think there was the economic survey where it said about spoken about dwarfs, right? So basically that our SSI policies were such that it incentivized firms to remain small. And I think there the government has made some changes, that they have changed the turnover limits, and other limits. So I don't agree with this thing that we've mollycoddled MSMEs. In fact, I think MSMEs need more support. What Omkar, I mean, they are in a way. I mean, where does SME begin? Where does informal start? Where does SME end? Where does informal start? It's all quite fuzzy. So I think that MSME is one way of formalizing the economy, and I think that all support needs to be given. Now, of course, Omkar had kind of asked the question in the beginning that where does the money come from, and that remains our biggest problem. That who do we prioritize and who do we incentivize and who do we support, given the state of revenues and given the state of the economy? That remains a tough question.
Actually, it's a nice segue into my next question. It's that Mukesh mentioned US debt to GDP is about 137%. I think in China's case, it's over 170 odd percent. And India is likely to cross 100%. So all these are required stimuluses, but there is a bill associated with it. So Taimur, it's like what Javed said, you don't have the luxury of, calibrating our response. You have to do everything simultaneously. So you don't have resources, but you have to spend resources. So Taimur, if you were to advise the Indian finance minister or the Indian Prime Minister, what would it be? How does India approach this dilemma that you don't have the resources, but you need to spend the resources and you're racking up huge debts?
Well, now is not the time to worry about fiscal orthodoxy or fiscal responsibility. Now is the time to put the fire out. So therefore, there is no hesitation that you print more money and you support the debt issuance. I mean, for the short term, it's got to be done. It may not be the best prescription for the longer term, and there has to be a glide path to normalcy. There has to be some credible signals given to the market that the government remains serious about fiscal responsibility of the medium term, but those things are for another day. Now is not the day. I'll give you one illustration of the point that Mukesh Aghi was making about his concern about the US debt. So, US has gone through several debt cycles over the last 40 years. So Reagan came to power, gave huge tax cuts, and US deficit and debt went up. Then Clinton came to power right after George Bush Sr., spent 8 years, balanced budget amendment, and by the late 90s, we're thinking that you would run out of treasury bills. Then came Bush Jr., big tax cut, debt went up. Then came Obama, first few years, he had to deal with the crisis, then painful consolidation all the way to 2015-16. So all these cycles, what happened to US interest payment as a share of GDP? During the entire time, it kept on going down. So today, US debt GDP ratio is the highest we have seen in any generation. And it is the interest payment as a share of GDP is the lowest we have seen in any generation. So again, for G7 economies, whether it is Japan or Europe or the US, the so-called, Reinhard Rogoff red line of 90% of debt to GDP ratio being a risk, not an issue. Nobody worries about that. The IMF does not. Even Mr. Kenneth Rogoff at Harvard does not worry about that anymore. But emerging market economies, as you correctly say, Anil, we don't have that luxury. Foreign investors will hold the government to the gravitational pull of fiscal responsibility in the medium term. But I can assure you that whether it is Moody's or Fitch or S&P, they are not going to punish India with credit rating downgrades if this year and next year fiscal deficits were to be in double digit, and that required huge amount of support from the RBI. Anil, you're on mute.
Sorry. Yeah. Hi. Thank you. We are out of time. We had Ravi. Are you on the call? We have. My understanding was we sign off at 7:10 or 7:20.
7:20.
7:20.
Okay, great. So we still got a lot of time. Right. I need 5 minutes, 10 minutes at the end, right? For Sanjay. So we have another 10 minutes to go. Okay,
Yes.
Great. So, I just want to come back, Omkar, to you on this whole point that Taimur made, that the fiscal dharma, which we know of, has to be reinvented. So what does it mean for India?
See, at this point, you have only two options, right? One is you borrow more or you monetize, right? I mean, there's only two options. You borrow more, you basically borrow more, or you go back to the old good ways and means kind of advances and monetize it, right? The issue right now is to take that decision. The finance minister, no civil servant will take that decision. To take that decision, the finance minister, with full concurrence of the chief minister, or of the prime minister, has to say yes. She has to explain to him why this is necessary. He's always going to ask, now that we agree to it, where will it go and how will you ensure that it will go there? She has to come up with proper answers. He would like it in 2 pages. He will quiz her, and she has to have the political courage to do so. I'm not saying that she can't, but the real issue now is exactly what Taimur is saying, that we are losing time. The more we let subsequent weeks go by, the opportunity of doing that is gone. And and then you can say it's not worth it because it's already gone. The opportunity is gone. So that's the issue right now. We don't have much time. We've got about 4 weeks to make some calls. If we don't make those calls, then, we drift. Of course, we'll come out of it, but we'll drift.
Mukesh, you again have the ringside view from abroad. What is the perception that you are gathering about India's policy actions, response to the COVID pandemic? What is it that you are gaining when you look at India from outside?
Well, I think on the lockdown, I would say India did a better job than the US did. The US was an abysmal failure as far as the lockdown goes. But I think when you look at it from a policy perspective, what we see all the time is there's a lack of predictability. You come with one policy and then you change that very, very fast. And that's very evident when you look at on the e-commerce side. The issue also becomes a transparency, the process. The global investors, especially US investors, would like to see that beside predictability, a strong transparency process in the policy making itself. And when we talk to our member companies here, they also say, listen, make sure that we also get a level playing field because we are going to invest long term. And if the policies are not long term and they keep on changing overnight, then if you look at very few institutional investors are coming, especially from the US, into India itself. So I think we need more predictability in the process itself to encourage, especially institutional investors coming into India. But as far as the economic response to COVID crisis, we see it rather haphazard. I think very conservative, and we'd like to see India be more aggressive, especially in lowering the cost of capital, availability of the capital. But again, that's more a domain of Javed and Omkar and others. But from an outside perspective, I think India can do more to get the economy revving up.
Thank you, Mukesh. There's a question that has come in. Is India hopeful for a quick economic recovery? I'd like all three of you, Taimur, Omkar, and Javed, to weigh in. Where exactly are in this alphabet soup, whether it is U, V, W, K, or whatever recovery on India?
I'm not into alphabet soups. So my answer to you is, am I at my age in the hope of looking like Alain Delon?
Okay, Taimur.
Okay, I will bite the bullet and embrace the alphabet. I think every economy is now characterized by a K. Some parts of the economy are doing well, some parts of the economy are doing poorly. It's true in China, it's true in the US, it's true in India. You've seen tremendous green shoots in certain aspects of the economy, even in India in the last couple of months. But of course, that is only part of the picture. So that little squiggly K with some enjoying, but then many others being left around, that seems to be the case. Now, the global pull is a very strong pull. And I think a lot of economists in recent years have shown that India's trade GDP ratio, India's openness quotient is not that different from many other East Asian economies, including that of China. So when there is a global tailwind, India benefits. When there's a global headwind, India suffers. So let's hope that worldwide, all these efforts that are being taken place on the vaccine issue, on pandemic resistance, on economic stimulus, all of those things spill over into India in a positive manner, and order books of the L&Ts and Reliances of the world get filled up. Export engine starts humming, which, by the way, actually has started humming already. We've seen some decent numbers out of this export sector also for the month of August. Hopefully, we'll see it again for September, October. And that then percolates through the whole economy. I mean, so the hope is that it will be pulled up by the dynamic parts of the world, and India will also join that dynamism.
Javed?
So no, I agree with Taimur. It's going to be K-shaped, and also see, it's going to be a painful recovery. You can't have scarring and then expect that that there's going to be no pain. So it's going to be a painful recovery, and I would like to hope there will be a rapid recovery, but I don't think so, because my point is that the fundamentals of the economy were weak before this. So it's not that this is a one-off event that has happened, right? And so all the other issues that we haven't discussed today, right, they still remain. So the issues that existed before March 2020, they're still very much on the table.
And I want to flag one thing to what Javed said, Anil, which is as we come out of it painfully, there is going to be a huge problem of non-performing, actually bad loans increasing in things, and somewhere down the line, some sensible recapitalization, some privatization of public sector banks, a whole lot of things have to be done. Banking reforms, whose time has well passed. Now you can't delay it any further.
Actually, I have a follow-up question to both of you, since you're such keen India watchers. The kind of pain that the economy is facing, people are facing. You've alluded to them about your istriwalas, and all these people are struggling. So, so is it that we are not noticing their pain because they're not articulating it like the privileged rich farmers of Punjab who come to protest on tractors? Is that the reason? Or is it that we are a very resilient nation that, you have enormous absorptive capacity? I'm just curious, both of you, Javed and Omkar. Omkar, you can go first.
Well, I'll just say something. I mean, it's not relevant perhaps in any great degree, but I'll go back to the time I taught you. 3 million people died in the Bengal, right? In 1943. 43 is a long time ago. 3 million people died, 1.9 to 2 million on the spot, as it were, and died because of malnutrition, right? In that whole period, over that relatively short area, small area called Bengal, where the famine, there was only one little tiny revolt that the police could break up quite easily. The ability of us we believe that we have been hurt by something, and economic hurt is not hurt. The ability of us to be able to absorb economic hurt as distinct from familiar hurt, girl being hurt, other things, right, is huge. And sometimes I wish we wouldn't be so kind.
Anil, I think you're on mute again.
Sorry. Thanks. Javed, the last word is yours. We run out of time.
You see, Anil, responding to your question. So, see, after demonetization, I heard, and I'm sure you heard the same thing, that if demonetization was such a bad thing, why is there no revolt on the street? And yet, today, I don't think anyone, we all know that demonetization has caused its own pain. So, I agree with Omkar. And I think you made that point, we are a very resilient nation. Economic hurt does not result in people taking to the streets as much as probably it would in other countries.
Okay, thank you, Javed. Thank you, Omkar. Thank you, Javed. Thank you, Mukesh. Thank you, Taimur. We have come to the end, and it was, I think, a terrific, not a very organized conversation. It was pretty freewheeling, which probably generated a lot more ideas than we think when we hear this. So thank you again. Thank you, Pafi, and I'll hand over to Sanjay.
Thank you, Anil. I will just add, well, the two most perplexing questions which people in this country have had since the onset of COVID is, when will all this end? How long will it take for India to recover? And as it recovers, in the new geopolitical setup, what will be the areas which will hold fresh promise for India? What will be parts of the world which will recover first? Now, you couldn't have asked for a better panel of people than tonight to have asked these questions and to have got answers. On behalf of CAFI, I would like to thank all the speakers tonight. First, I'd like to thank Anil Padmanabhan for having moderated this session so ably. It's not an easy topic, and I think you have let everybody do a fair share of the talking. I would like to thank Dr. Omkar Goswami for amongst many of the gems that you have given us today. One I would like to reiterate, and that is, as a nation, we don't walk the talk. It's almost become a national character, and unless we shake this off, I don't see ourselves getting very far. I would like to thank Dr. Taimur Baig for his view of India as seen from Singapore, and your innate belief that we have not yet integrated to the extent that we should have with ASEAN, and still there are opportunities for further integration. The sooner we do, the better. I would like to thank Mukesh Aghi for giving us the US perspective, and especially his belief that in the new geopolitical setup, in the new geopolitical reset, which is not just diplomatic and strategic, there can be economic opportunities for India as well. And I hope our government starts seeing the US-India partnership and the partnership with Quad in that perspective. I would like to thank Javed Said for reminding us that there are many not so obvious imponderables at play. And let's hope that we bounce back quickly and put all this behind us as soon as possible. Thank you very much.
Thank you.
So I just want to say thank you all. The next session for the benefit of delegates starting at 7:25 p.m. Many thanks.
Thank you.
Thank you.
Finish your time.